Good morning, everybody. On behalf of Pentagraph team, I, Yogesh Mehta, welcome you all for today's Pentagraph Knowledge Series. Today's topic is update on G20 Summit and implications of India inclusion in global bond indices. These are two major events which took place recently and will have a long-term impact on Indian economy. We are honored to have Mr. Arjun Nagarajan here with us to present the insight on this topic. He is a chief economist and communication manager at Sundaram Mutual Fund with a career of more than 12 years in equity market. Arjun is an accomplished economist and has been part of Niti Aayog discussions on topical issues and also participated in pre-budget roundtable consultation with the Honorable Prime Minister of India. Thank you, Arjun, for joining us today. I welcome you on behalf of Pentagraph family to enlighten us on and give us a clear understanding how long-term impact of G20 summit and the India inclusion in the bond market indices. Welcome, Arjun. Before I proceed further, I have an announcement to make. The session is on listen mode currently. Meanwhile, all participants can write their queries in chat box. The Q&A window will open only after the session is over. Arjun, floor is yours. You can take out from here.
Perfect. So I normally start off, I keep a little timer just to see to it that I don't really go past that. So I just started my timer. Yeah. Okay, perfect. Thanks a lot, Yogesh, and thanks, Pentagraph, for having me. Saturday morning, so I really won't talk too long. I'll keep it fairly quick and brief. So I think more Q&A, I think I'll be very happy to take that. And these are two events. So I'm breaking this down into two segments. One is G20. Second is your India bond inclusion. So of both of these, the second one has more near-term market implications. And the first G20 is more, one can't really say there's a definite market implication, but nevertheless, you really need to know what the G20 is all about and what is it that India really achieved and what the key takeaways are. The key focus of the G20 is the corridor. So I'll broadly be touching upon all these things. And why is this such a big deal? It is a big deal. Why is it such a big deal? So I'll just start off. Yeah. So this is again, the first few slides is just general gyan in a sense that you've been reading all of these in newspapers. So G20 has been there, I think, since late 1990s, but G20 discussions and meetings at the head of state level, that most in a very practical form started only after GFC, after the financial crisis, because it sort of helped the countries to sort of recover from the slump that they saw. Plus, it was very important to coordinate monetary policies, fiscal policies, especially fiscal. So that was actually one of the key practical aspects of G20 to start off with. And the other more important bit is they didn't want countries to go protectionist because of what they saw. They wanted more globalization, more integration with the global economy. And that was, I think, the main key. But unfortunately, or fortunately for India, again, post 2008, post the financial crisis, US and China, there have been a fair bit of disputes. And that has sort of dominated most of the G20 meets post GFC. And recently, it has been the fact that Russia and China have sort of bunched up together. They've tied hands together. They seem to be one extreme pole there. Now, apart from all the marketing that is done on G20, apart from all the airtime that G20 really got, I think the biggest positive for G20 is, so India presiding the G20 is no big deal because it was anyway on a rotational basis. But what we made of it is, I think, the most important. It was a prestigious opportunity that we really utilized to almost the fullest. And thanks to at least the narratives from the G20, I think it would be reasonable to say that the India's successful G20 presidency is sort of a precursor to leading the role in the global south. The fact that we nudged and brought the African Union into the G20 and made it 21, I think that itself speaks a lot. So quickly on what exactly is this G20. So this was the 18th round, roughly around 200 plus meetings, 60 plus cities. And one highlight was that the declaration was 100% accepted. There were some modifications here and there, but broadly it was accepted. The biggest highlight of the G20 was the fact that there was this India, Middle Eastern, European economic corridor. That I think is the most important aspect of the G20 that I'll be talking about in another minute or so. But other aspects were you had a global biofuel alliance. So anyway, India is trying to increase the ethanol component. So our imports of crude, we are actually spending lesser money on imports of crude. So these have a longer term. These have a lot of positive implications, but there are also a lot of difficulties because, say, for example, currently there's a good part of rice and sugarcane that we actually use to make biofuel that we use to make ethanol. That's not a very sustainable model, at least at this point in time, because sugarcane is very, very water intensive. So in the shorter term, it has some positives, but in the longer term, we will have to switch to more of maize or corn. That is, we'll have to switch to a different basket in a certain sense. Those are longer term challenges, but nevertheless, the fact that this has started, I think, is a big positive. FTA with UK, you're enhancing MSMEs access to information. See, all of these are broad, sweeping statements. Uh, what is important is to see to it how much of this actually translates on the ground. On the climate and financing, there were some positives. So the Green Climate Fund, there's been a replenishment there. There's a lot of focus on the developed countries also pitching in a bit more on climate. The African Union, that they were added to the G20 now as a 21st member. A Trans-African corridor. So all of these will depend on how the negotiations continue going forward. And then you had a Startup 20, then you had dispute settlement system where the WTO is expected to sort of lays between all of this, and then reforms towards multilateral development banks. These are broadly the key takeaways if you see, but the one thing that really stands out of all of this is the IMEC, which is the India, Middle East, European Economic Corridor. Now, on the IMEC, that I think is the most important and the most relevant part of the G20 meeting. Now, geopolitics, the last 2-3 years that we've been seeing, has been evolving to levels that we've never ever imagined. Nobody would have really thought that India-Russia ties would have actually picked up so much. India would have really asserted its stance on the political front and on the diplomatic front globally. We never really thought India would have been as assertive as it has been. There have been a lot of critics, but I think it has completely worked in India's favor. And in hindsight, I think that probably was the best thing to do. And now US is appearing to be playing a fairly important role. And for the lack of a better word, you have US and India in one corner, and the relationship between US and India is getting better. Now, why is this important? So if you look at how China rose to power, so if you look at 1980s, GDP in China was slumping, GDP India was slumping, per capita income, it was a race between India and China as to who is going to be the weakest, who is going to be the lowest on GDP. China beat us on that race. China was actually the lowest on GDP in 1980s. We were better than China in 80s. But then what happened? You had a set of reforms. Deng Xiaoping came in after Mao. Mao passed away in, I think, 1976. Deng Xiaoping came in. After he came in, there was a lot of capitalist reforms. There was a significant reform that happened in China. One key bit was China-US relationships became extremely strong. They started getting very close to each other. And China got the most favored nation from US. So a good part of trade started going to China. And in addition to that, soon after, China joined the WTO. After that, China had no looking back. The early 2000s, those 1995 to probably around 2012 or so, I think was a significant time frame for China where your GDP was more like a straight line. That's how fast they grew. Mainly because they were able to enhance this relationship between US and with WTO to the maximum They realized this was the window they had to really grow, and they did whatever they could. Hook or by crook, they actually started pushing Chinese goods. They started really exporting. Now, after they joined WTO, there were a lot of clauses they were supposed to follow. There were a lot of issues. They kept dilly-dallying on that. They started pushing that. Not people weren't very happy. So by the late 2010, closer to the global financial crisis, the discontent around China was also increasing to a certain extent because they realized that China sort of used the opportunity and did not really stick to what their part of the equation. Now, all of this is just anyway history now. But the point I'm trying to make is that the reason China is what it is today was because of the fact that they got that window of opportunity with the United States, with the Western world. Whether we like it or not, the Western world is as large as it is from a GDP point of view. They have all the capital. They don't have the population, they have the capital. We have the population, we have the labor, we have the productivity. We need the technology, we need the capital. So if India has to grow, that reliance on the West, I think, is something that is inevitable, and which is where this US role comes in. Now, coming back to the IMEC, another positive for IMEC is it provides a much shorter route for India to Europe. Now, why is this important? We'll come to the geopolitics of it in a bit. Now, this, like I said, this is a US-sponsored push towards a new trade paradigm because US is also trying to maintain power and also try and give support to another country that they feel is not a threat to them, or rather they supported China and they realized they should not have supported China to the extent they did. They feel India does not really carry that threat, and as a result, to a certain extent, with some caution, they're sort of pushing for this. Second, it is 40% faster sea plus land route to Europe. It's 40% faster, and the distance is 18% shorter. So that's a very big positive there because it gives an alternate for India and an alternate for the world as well. Now, the other bit in this entire thing is the Middle East is a very large beneficiary in this equation. That is something that has been changing also over the last few years. Last 10, 15 years, the Middle East is coming across as a larger player in infrastructure, a larger player in renewables, a larger player in capex as a whole, global capex to a large extent as well. Now, IMEC, it sort of includes, like you see on your screen, India, Saudi, UAE, Jordan, Israel, and the European Union. EU, France, Italy, and Germany, they're also in agreement with the corridor. That I think is a very big positive. They're not really opposing the corridor because India also has a very good relationship. So all the foreign trips that Mr. Modi, our Honorable Prime Minister, has been doing over the last so many years, I think in hindsight, one can understand where all of that comes from and why all of that has been extremely important. Because at the end of the day, if you need an economic agreement to go through, apart from the opportunity, the numbers, the market size, it is the personal equation also that plays a fairly important. We can see that in the current president in the United States and the criticism and the flack that he seems to be getting. Now, one other point that isn't really talked about is just a few weeks before the G20 agreement. Okay, I'll talk about that, I think, when that comes in. So, okay, I'll talk about that in a bit. Now, the other bit is, if you look at China, China has a land route to Europe. China had the One Belt, One Road initiative, or they call it the One Belt initiative. It's also called the OBI or the OBOR or the OBOR. Now, just a few weeks before this G20, Italy sort of withdrew from the OBOR. Italy was the only G7 country that was a part of the OBOR. They withdrew from this Chinese infrastructure project. So, in a sense, at least from a signaling point of view, you can really see that the West is aligning away from China to an extent and towards India. China and India have been aligned increasingly to Russia, but the India aligning to China, India has come out fairly neutral in this entire equation. China has not really come out as neutral as India. So the China plus one narratives from COVID, those narratives are still there. So I try to sort of reduce the intensity of those China plus narratives because the market adds a lot of what do you say, political jingoism to it to a certain extent. China plus one is a very positive initiative, but nevertheless, we must sort of tone the narrative down because at the end of the day, China plus one will only happen. The first priority will be to countries that are in and around China because a good part of what China produces is for consumption within China and in and around its own countries. So for that to move to India, the opportunity will be to the nearer Asian countries in and around China, and only then it comes to India because logistics is a very important role to play. So all the produce that goes to the Western world, that I think there's a very likely possibility of that China plus one to come to India, largely because the logistics is not as much of an issue. And if this comes through, then the logistics becomes even cheaper because it's an 18% shorter route, which means your logistics cost will also come down, maybe not by 18%, but nevertheless will come down. And the time also taken is much lesser. So that is the opportunity also that the IMEC sort of brings about. So this is a non-China economic corridor, an alternative to China's OBOR. Now, when one says it is an alternative to China's OBOR and it is a non-China economic corridor, we must always keep in mind that we cannot compete with China. I'll just put this chart in front of you. Just assimilate these two little circles. This is how big China is, and this is how small India is. China is nearly $18 trillion. We are just under $3.5 trillion. China puts out, if it continues to grow at 5% every year, China puts out in every 4 years, China puts out in India. So whenever we talk about China, India, one must understand that we cannot grow at the same pace China grew. China is not a democracy. All democracies have a much slower pace of growth. That's a fact. So what China took 15 years, what China took 15 years, we might take a couple of decades or even more to match that pace of growth. But nevertheless, we have to accept that our growth rate will be, at least for the next few years, will be the 6.5, 7. We won't be touching 8, 9, 10%. For that to happen, we need really an infra boost and a boost to exports as well. Now, infra boost, this doesn't give, the IMEC doesn't give too much of an infra boost, but it gives, if you really tap it well, like China did, it gives a boost to exports that that we never ever had before. Sorry, that we never had before in the past. So that is the opportunity that this gives us, and we have to really make use of the opportunity. So the point that I'm trying to make here is whenever there is an India-China comparison, please tone it down. We are not a competitor to China. We can't really. On the labor front, we can compete because our manufacturing wages are much lower now, but mainly because of the fact that Chinese labor force, Chinese wages have gone up a fair bit. But on the technology front, on the productivity front, we are not really on par with China as yet, but we can get there. Now, coming again to IMEC. So IMEC, there are two broad parts to it. So one is the Eastern Corridor and one is the Northern Corridor. So Eastern Corridor is the part that links with India. It is India linking with the Gulf. And then the Northern Corridor is Gulf with the rest of Europe. I have another slide that shows you with this in a chart form. You can actually understand it better. Then you have, within that, you have a network of railway lines that actually, within this Arabian Peninsula, that goes all the way and it goes beyond towards Israel and Jordan. Now, this is something that we never had before. So this opening up is going to be quite significant as and when this happens. Now, shipping line towards mainland Europe from the Haifa port. Now, I'll tell you why this Haifa port and all of that is also important. Now, After the G20, the agreement as per the agreement, I think they within 60 days they have to sort of meet up again to formalize this framework. So all of this, the plan is good, the blueprint is good, everything is good. We don't have too much of details, but whatever details that we have, the opportunity seems to be quite significant. But the most important is this has to come through. This has to, all the political parties in all the countries that are there currently, they have to continue, even if the political parties change, their views do not change. So there are a lot of ifs and buts here, but nevertheless, that is important. Now, why is this important? So if you look at India's map here, India's connection to Europe, apart from the sea route, which is very, very long, because you have to go all the way around around the Middle East and sort of Africa. But the other land route, we don't have Pakistan occupied Kashmir at this point in time. If we do have POK, that opens up a completely different route, completely on land. So if you can see just above what is written as Kabul, this is your POK. If you get this part, you have a completely different access to the entire Asian peninsula or Eurasian continent. We don't have that at this point in time. So the immediate bit was, at least earlier, was the Gwadar port, which is in Pakistan. That for very obvious reasons, that is not something that we can. We started getting a little pally with Iran. So the Chabahar port was something that was very important. That also is not that great now, because Iran also is not in a very great space, and India-Iran relations also are not at their peak, unlike India Middle Eastern relations. So what happens here is you already have two ports that we couldn't. Now all the way we are going all the way here. We're going in through here, and we're going down into the Saudi and through the Middle Eastern route. So these two sea routes that are currently there are not operational, or are not, in the sense they cannot be optimized for very politically related reasons. Now this is the alternate. So what happens here is, this is the Eastern corridor. It comes all the way here. It goes in through this little strait to Dubai, and then through Riyadh you have a rail line. It goes to Haifa port here, and from the Haifa port it goes here. Piraeus is in Greece, the Greek port. From there, again, a railway line going all the way. I think it goes to Hamburg in Germany. So you have two sea corridors and two rail networks to a certain extent. I think this is the layout of the IMEC, and the most important part is that it gives us an alternate to these two sea routes that are already having a lot of political issues. Now, given our relationship with Middle East is really very good over the last so many years, I think the likelihood of this coming through also is quite positive. Now, this is the other bit that I was talking about the how short it is. Now, the dotted line is the current IMEC. The darkened line is the older one. The older distance was 6,800 kilometers. The new distance is around 5,600 kilometers. It is much shorter. The time and the distance is much shorter. So it is a bigger positive. Plus, the most important bit is you don't have political uncertainty, or the relationship between India and all the countries that it goes through politically is fairly favorable. Now, why is this important? So infrastructure is only one part of it. And if you notice here, the entire leg of this, the Indian leg, is actually a much smaller part. So infrastructure is only going to be out here. So the larger part of the leg is actually what connects Middle East to Europe rather than anything else. So infrastructure is a positive. I don't have the numbers as to how big that can be, but nevertheless, all of this is work in progress to an extent. But the most important focus of IMEC is exports. So if you look at this chart here, the bars are in US dollar billion. The light blue bar, it talks about all these countries and their total trade. The dark blue bar, which you can barely see here, is India's trade with these countries. So if you look at India's trade with France, India's trade with Germany, India's trade with Israel, Italy, all of them, they're barely anything. There is these countries trading with India, those numbers are barely anything. And all these countries is what this IMEC goes through. It gives us a direct opportunity to start a much cheaper and a faster route of trade. So we have to really up our manufacturing by the time this comes up. Now, the line here is trade with India. So if you look at trade with India as a percentage, it's roughly 4% of Israel's trade with India. Italy is 1%, Jordan is 7.8. So this is broad. So you can really see the opportunity that actually this gives us. Now, if you break this down, look at what does France import from India and India share there. India share in that particular segment. What does Italy import from India and India share? So you can actually see all these numbers here. For France, India's share in France exports is under 3.5%. Nothing is really anywhere close to that. 3.5% is actually refined petroleum. Clothing, footwear is somewhere just under 3%. If you look at Italy, iron and steel is around 7%. Clothing, footwear is just about 2%. Then you look at Germany here, clothing and footwear and iron and steel are the top. Even though they are the highest, it's only around 2.5%. You look at Saudi, your chemicals are higher, your refined petrol is higher, sugar is around 25%. So if you can see, our trade with the Middle East is quite sizable. You can see all of these are in double digits. But if you look at our trade with France, with Italy, with Germany, they're under 5%. There's very low single digits. And this is what this IMEC can sort of help change. You look at UAE per se, all of them, excepting maybe a few here and there, all of them are broadly, UAE, all of them are above 25%. So this is the opportunity that IMEC gives us. Infra is just one side leg to the entire thing. So yeah, this is broadly about the IMEC per se. So the biggest takeaway from IMEC is two. One is the geopolitical narrative that we have created, we have used to create with that. The fact that we've had a great relationship with all the Western countries to a large extent now, and even the tussle we had with Russia, though it was a little acrimonious to start with in from Europe at least in now it seems to have come out very well. And India, the neutrality of India is being appreciated much more. The criticism seems to be relatively less. You will hear criticism because India is an emerging power. So whether we have beaten China on GDP or not, we have beaten China handsomely on population. This year we will be the largest and the most populous country in the entire world. We will remain the most populous country in the entire world for another 100 years flat. Now, that is a very significant thing. We will be the most populous country in the entire world with the disposable income to spend. Being the largest population alone is not important, but that population being able to spend, having the money to spend is extremely important, because at the end of the day, money speaks. From a country's point of view, every country wants to be present in those regions that are very popular, that are very where the markets have a significant amount of opportunity that are underpenetrated, which is also the main reason why US still trades with China. Because if, for example, for all the negatives that the US talks about China, say, for example, the human rights that they have, the issues they have with Xinjiang, trade has come down, but they still trade. iPhones, China is still a very important, so that shift is anyway taking place, but nevertheless, China as a market is extremely important to the Western world. Their narratives are one side, but they realize that they can't cut off China completely. They have to develop alternates to China, which is why they're sort of de-risking. But at the end of the day, China is a very large market. It will remain a large market even after another 10 years. And that is the main reason why companies, American companies, still want to be present in China. Because at the end of the day, money speaks, money is fungible. Companies want to make money, may want to make profit, shareholder value, their entire value chain. So India will remain relevant. The biggest question is, can we take charge of our narrative in these 100 years? If that is possible, if we can do that, I think we can squeeze the maximum out of all these agreements of the IMEC, of all the geopolitical relationship, positive relationships that we have built over the last decade or so. Yeah, so that's largely the takeaway from G20. Now on bond inclusion. So now there are three things. So what we've heard is the bond inclusion around the JP Morgan bond index. So it's roughly around 25 billion FII inflows. And if you look at it from a yield point of view, there is a positive yield narrative that also comes through this. Now, there are three bond indices that you broadly have. You have the JP Morgan bond index, you have the FTSE, and then you have the Bloomberg Barclays. It's only the JP Morgan that has come in at this point in time. So the significance of this is because of the fact that so much of flows are coming in. So you can look at the right end of the chart, and so the left chart talks about how underinvested the foreigners are in Indian debt. And the right end of the chart, you actually see that if this money does come through, why is it significant? It's roughly around 0.6% of India's GDP, around 1/3 of India's current account deficit, around 0.6 near 0.6 times India's net FDI, 7% of the fiscal deficit, around 10.4 times India's annual portfolio flows. If you look at the 30-year average portfolio flows, they're not really great because you had a very large chunk of the first 5 years that didn't really see too many flows. So this is mainly the biggest positive, the fact that a good amount of money will come in, and there is at least a chance for some stability on the currency. So yeah, I think that's largely it on the bond index. I think there are more questions on the bond index that one can possibly ask. I don't really think there will be too many questions on IMEC, because on IMEC, whatever I've known, I know I've sort of put it on those slides and I've sort of explained them. But on the bond index, I think there can be a lot of questions that can come. A lot of discussions can happen on IMEC. So I think I'll stop here. Yogesh, if you have any questions, please feel free. And after that, we can probably open up for Q&A, and then we can take it from there.
Yeah. So thank you so much, Arjun. I think you have a detailed talk on G20 and very insightful session on G20, how it will benefit India and how it will benefit our Indian economy. So before we wait for questions from our participants, our guests, so let me start with a very basic questions on a G20. So now, why did the G20 was scheduled to at a different part of India, and how that will help Indian government in terms of what is motto behind Indian government to conduct this G20 in different part of country?
Yeah. So see, this is an election year, a pre-election year. So from a government point of view, I think the marketing part of it is extremely important. The how they actually put it across is also fairly important. Secondly, what the G20 has done. So if you look at hotel occupations, if you look at room rates, if you look at flight costs, all in and around the G20 meeting, you've seen a significant buzz of activity. So one thing that is really positive is that they've not really limited the G20 activity to just one particular place. They've spread it all across the country. They've given a feel-good factor, again, pre-elections to all those regions. I don't really know if those regions have been chosen from a political point of view. I wouldn't really be surprised if that has been the case. But at the end of the day, it does translate into a significant amount of activity. So we know for a fact that the hotel industry has really seen a significant pickup. So when the hotel industry has to really pick up at least capex from a hotel point of view, more rooms, more investment going in there. from more activity on passenger traffic. So broadly, I think it's a positive from an economic activity point of view. And if you look at India's growth on the whole, it is always cities that have driven growth. Say, for example, I was making a presentation a few weeks ago, and I was just digging some data on per capita incomes. So I was very surprised to know this. Vijayawada, that is their per capita income of that city is roughly around $18,000. India's per capita GDP is $2,300 per capita GDP. Vijayawada is around 18,000. So Vijayawada has a lot of iron and steel, has port as an industry, and you have a little bit of IT, but largely these two industries. Then if you look at Coimbatore, their per capita income is roughly around $15,000-16,000. The city alone, it's largely textiles. And these cities have grown to such significant levels. So the per capita income is so large because populations are lesser, but the industries are much more, which means the value add that these two cities have created are quite significant. So it is extremely important to really build more and more cities where, and if you look at India's cities, say for example, Vijayawada as a city is a very different city, driven by completely different sectors. If you look at Coimbatore, 15,000, 16,000 per capita GDP, a very different city, a very different driver. If you look at Bangalore, around $6,000, $7,000 per capita. No, I think Bangalore is 8,000 per capita GDP. Again, a very different driver. Every city in India, if you look at them, the drivers of growth are completely different. And it is this, when the minute those cities sort of develop, you see it percolate, you see second order, third order effects across to tier 2 and tier 3 and tier 4 cities. So I think that probably was what they had in mind when they were very keen that it does not happen in one particular place. It is spread out all over
India. Great. Thank you so much. So now we have received questions from our advisors also and a client also. So the second question is that so this inclusion of bond in an Indian market, it happened because they have exited Russia from their index. Okay. So I want to understand what will happen if Russia re-enters into the same indices.
Okay. So that is a very hypothetical question, but I don't think Russia can ever come back because I think they've burnt their bridges with the West to a large extent. So, like I said at the start, India has the population. We don't really have enough capital. We don't have the technology. So this is actually very important because it brings in a good amount of capital. So one should remember that if you look at India's current account deficit, we have a current account deficit because, for example, one way of looking at it is that we import more than what we export. But the theoretical way of looking at the current account deficit is that there's a fair bit of a gap between your savings and your investment. You don't have enough savings for the investment that you're currently doing, which means your investment is higher than your savings. Whatever gap there is between the savings and investment is exactly your current account deficit. So if you look at the savings investment gap as a percentage of GDP, it will almost always sort of be equal to your current account deficit as a percentage of GDP. Now, the important thing here is that the bond inclusion will bring in the money and will bring in the capital that can sort of bridge this gap to a large extent. Now, can Russia come back again? I don't think that's a possibility. So I think it is an opportunity that we have used. But now there's another thing here that the reason why the bond inclusion has not happened so far is largely because of the fact that the government has been very clear they won't really make any tax stops for this. So far we understand that this JP Morgan bond inclusion, there has not really been any effort from the government to tweak its tax structure. So the two things was, I think, one, withholding tax was one issue and capital gains was one issue. The bond inclusion, a lot of investors wanted that capital gains to actually be taken away and they wanted a lower withholding tax. Both of these remain as they are. I don't think there's been any change in that, despite which JP Morgan has said, okay, we'll go ahead and bring about this bond inclusion. So I think it is the need of the hour. And if the minute Russia goes out, they don't have any other countries to add on or increase weights where their macro stability is as decent as India. And plus, India, like I mentioned earlier, like China was 20 years ago. So we are exactly where China was in 2007. If you look at per capita GDP, we're exactly where China was in 2007. So we also have very similar opportunities. We have similar pace of growth. So from that standpoint, India is a country that no Western index or no Western investor can ignore anymore, because with political stability and with macro stability, the opportunities to invest will only increase rather than come off, because volatility in the currency will come down and volatility in markets also will come.
So with the follow-up questions to you, what is the relation between the currency and the bond in EM?
Okay, so two things. So this is expected to bring roughly around, so our weight in the index is 0. This is going to go to around 10%. From June of 2024, they're going to be adding 1% every month, and it takes it up to around 10% or so.
Yeah.
So this roughly will bring in around $25 billion. Now, this $25 billion is purely a debt investment. This is not likely to come immediately. This is most likely to start coming only closer to the inclusion rather than before. There are some people who actually feel that this is going to come immediately and the currency will get impacted positively, etc. I don't think those narratives are reasonable narratives. I think it's most likely that the flows will come in only closer to the inclusion. So probably start of the Q2 of 2024, which means June quarter of 2024, closer to end of Q1 and start of Q2. I think that's when the monies will start coming. Now, again, I'll just give you 2-3 numbers. So the FTSE is not coming through. At least I think yesterday there was some news flows on Reuters. So FTSE had a review this week, last week, where they sort of decided they will not go ahead with bond inclusion. So as of now, we only have JP Morgan. FTSE is not coming through because their review is done. I think they'll review it next year or the year after. Bloomberg Barclays, we've not really, I don't know when their review is, but they're not joining as yet. Now, FTSE is a bit, so the AUM wise, JP Morgan is roughly around just above 250 billion. Bloomberg Barclays is much bigger, is around 2.5 trillion is the size. But India, if it does get added, it will only be around 0.3-0.5% of the index, which means flows will only be around 13-14 billion, won't be as big as JP Morgan. JP Morgan is more important because the flows it can come is 25. Now, what happens with flows is when money comes in, two direct impacts happen. So bond yields will start coming down because there will be a significant amount of money that over a 25. So if you look at bond FII investment in bonds, you can see in this chart here, is fairly low. The last 2 years, if you see, they've barely seen any amount of money coming through bonds. Maybe it's been barely marginal. For most part of 2023 and a good part of 2022, we saw 0.2%, 0.5 billion, 0.3 billion. We barely saw any significant amount of money. So this will be 25 billion coming through just in a 10-month window. So there's a very likely possibility that bond yields will come down. Now, why is this important? If bond yields come down, which is GSEC bond yields come down, your GSEC is your risk-free rate. So if your risk-free rate comes down, your corporate bond yields also come down. There are a lot of estimates going around. I think 25 to 50 basis points is likely the impact that it will have on lowering your yields, which means your corporate bond yields might also come down a bit. What this means is the cost of capital for businesses will come down. Now, when cost of capital for businesses come down, it is a direct positive for equity markets. So you know the Kaplan formula, you know how equity markets are actually valued. So if you look at the bond yield and earnings yield, the bond yield is a very large component of that. So if your bond yields come down, it means it has a direct impact for equities per se, valuations per se. So it is a broad positive for equities because the cost of capital is coming down. It is a very good positive from a debt point of view because yields are coming down. Now, the key thing to note here is from a currency point of view, the impact on the currency will depend on what the RBI does with this. Now, we have a very clear view on the currency. We've been having that for a while now. We wrote it in detail just a couple of days ago on the currency. So you can actually find it on our Twitter handles as well. So on the currency, one always has to remember that we are a net trade deficit country. Every year, India's currency will depreciate. Our average depreciation of the currency has been roughly around 3.3%, 3.5% has been our annual average over the last 30 years. There is no reason that will change. There was a very strong narrative, and there still is a very strong narrative that India is going to start seeing appreciation on a very sustainable basis. And after the Russia-Ukraine war, you had a lot of narrative about India, China, all those things coming through. I think my only answer to that is that, see, China in 20 years has been trying to move away from dollar dependence. In 20 years, China, a non-democratic country that can take decisions very fast, they themselves have been able to move only 16-17% of their entire total global trade away from the dollar. So if India is able to do even 3% in the next 20 years, that's a big feat. So this entire narrative of rupee trade, of China, of the de-dollarization, breaking the back of the dollar, I don't see any of that coming through. Nevertheless, the rupee trade narratives are very significant. They are positive on the sidelines. They are not going to make any paradigm shift as long as I understand that. So from a currency point of view, if the bond inclusion does come through, the question that one has to ask is, what is the RBI going to do with this? Our view has been and continues to be that the RBI will not allow the country currency to appreciate. A moderate appreciation you can see based on what the global situation is at that point in time. I'll tell you why that is important. Now, so far, the RBI has been very clear from the start of COVID. Pre-COVID, we were 300 billion. We are now 600 billion plus on forex reserves. So the absolute number of forex reserve is completely a useless metric. What matters is how much of imports can this forex reserve give us? That hasn't really changed much. Despite the increase in forex reserves, our import cover, which is your forex reserves on your total imports, is roughly only around 10 months. We only have 9.5, 10 months of import cover. A comfortable place to be will be 12 to 18 months. So if there is a significant amount of money that is coming in through these flows, the first priority for the RBI will be to beef up, to increase the forex reserves of the Central Bank of India. And if the RBI buys the dollar, what immediately it happens is it has to sell the rupee. So if it has to sell the rupee, which means domestic liquidity will increase. And at that point in time, if the RBI is comfortable with excess liquidity, it means that the shorter end of the yield curve will come down because there is much more money in the system. Your yields at the shorter end is very likely to be much softer than what they are today, which means the yield curve that is largely flat can get a little steep at that point in time if this is what the RBI is going to do for to the forex money that is coming in. Now, so that is largely going to be the impact. So if they do this, the simple fact that the RBI is going to be buying the dollars will curb the appreciation in the rupee. So if the rupee, let's say, is depreciating at 3.5%, maybe they will see to it that the depreciation is maybe 2.5% or 3%. Remember here, the 5-year average of rupee depreciation in the last 10 years has been 4% plus. Last 5 years has also been 4% plus. So somewhere in the range of 3.5% or lower depreciation, I think, is what one should expect. Not an appreciation in the currency, is from an annual average point of view. I think that's broadly how I would want to look at
it. Fair enough. Fair enough. Great. So now we have another questions. So what will be the impact on global equity post 2020 summit? Do you see any opportunity to invest in global equities?
Okay. So I don't know what's going to happen to equities next week. So 2027 is a very long shot. But I'll just show you one chart here. Now, this is the most important chart that one has to take away from Indian market returns. So I've done two things here. I've plotted the Sensex returns here, which is in blue, and the S&P 500 returns that is in red. This is only updated this only till June or so of this year. The biggest positive here, the biggest takeaway from this chart is that India market returns directly tag global market returns. The key word here is directionality. So both of them are on different axes. So if you S&P 500 gives you 10% return, India gives you 15 or 18% return. But there are phases where India macro is weak, where the absolute return India gives you, say, for example, a 2013-14 or 2018, where India absolute return in rupee terms itself was lower than S&P 500. But on average, if you see, our returns have been much, much higher. Whenever India's macro holds up and India's macro is strong, India returns are much higher than global S&P 500 returns. Now, as of today, if I look at returns post-COVID, in dollar terms, India returns are much higher in dollar terms, not in local currency terms. In dollar terms, India's returns are much higher than S&P 500. Now, if one wants to re-index this to 2000 mid of last year, then it will be a very different thing. But from COVID, it's very, very different. Now, there is always a catch-up that India returns do. If US returns go down, directionally, we will keep going down. So if you look at December of 2020, where US markets started going down and went negative, Indian markets also went down, but they didn't go negative. They didn't go very briefly for 1 month, they touched negative. US markets, so if you remember December of 2022, US markets were I think somewhere around minus 18%, and India market was 4%. Then after that, the US market started catching up, and minus 18% became plus 18%, and our 4% became 18%. So delta was much larger, mainly because the US base case assumption changed from a recession to a no recession. So long story short, I would still want to think India as an investment destination rather than outside of India as an investment destination. But having said that, if you do want to invest outside of India, the rupee depreciation angle is a must, because people don't realize, say, for example, when you look at gold returns or S&P 500 returns or returns that you have invested in any other fund, you don't realize that that particular return will grow at the pace minimum of 3.5% return, which is the rupee depreciation gives you every year, which means even an asset class like gold will grow at 3.5% every single year because the rupee depreciates every year at 3.5%. I think that will be the most important. Global situation, I think we have been all through 2022, even though the markets were talking about a recession, we've been very clear, we've been shouting through the rooftops about how we don't expect a US recession. All through 2023, the markets came around, they said, hey, maybe we are wrong, we don't expect a US recession. We don't expect a recession in US in 2023 either. We don't expect a US recession at all. We've only been talking about a soft landing. And I think that soft landing will possibly happen in 2024, probably in the first half of 2024. We were earlier expecting that maybe it will happen in the December quarter of this year. looking at the macro data points, that doesn't seem to be happening, and the Fed narrative also shifting from March to June of 2024. I hope that answers the question.
Okay, great, Arjun. So next questions we have is, we have been pitching to upgrade India's rating. When can you expect this to happen?
I can only think of those interviews Jayashankar keeps giving about. I think people talk about the freedom index, the democracy index, etc. For the lack of any other example, I can only think of rating also to be one of them. So the thing is that if you look at European countries rating, even though their debt is so significantly horribly bad, barely any growth prospects, they get much better rating. The only thing I can think of is the fact that there is, say, for example, you look at the European Unions. Most of the European Eurozone countries, if they come out of the Eurozone, there's a very likely possibility that their ranking will just plummet. For example, Greece, or for example, Cyprus, or for example, all the other smaller ones. Now, the reason that's not happening to those levels is because, for the lack of a better word, there is a MAI-BAP in a certain sense. There is the Eurozone that's like a guarantor of sorts. So from a ratings point of view, I think that's the only logical explanation one can give, saying that no, if something happens, there is this guarantor that is so very powerful, that is powered by Germany, France, Italy, and Spain, that can take care of the country, and as a result, the rating is what it is. Remember here, Eurozone as a country is around 19 countries or so, including Lithuania. Of these 19 countries, only 4 countries matter. Germany is 1/3 of the Eurozone GDP. Germany, France is roughly 50% of Eurozone GDP. Germany, France, Italy, and Spain is roughly 78% of Eurozone GDP. So you can understand what this entire narrative is all about. So ratings, I wouldn't, as I think we are just above junk. We are at triple B plus, I think. We are at triple B minus. No, we are not at triple B plus. I think if we come to triple B plus, I think that will be a positive. But nevertheless, I don't think that is a narrative that anybody is bothered about anymore. That will change with time when India's growth also picks up, and India's stability also comes, and when they realize from a geopolitical point of view, they don't have any other choice but to recognize the growing power that India is. I think these attitudes also will change.
Okay, great, Arjun. So I'll take a last question. So with the bond inclusion in the bond indices, which are the equity sectors you feel that it will have a better perspective for next 4 to 5 years from here on?
I would say all sectors, because the cost of capital impacts directly. But one sector that immediately comes to mind is financials, because there's a certain leverage there as well. And because you also, say, for example, if bond yields come down quite appreciably, your SLR book of banks will actually come down. So that will be a positive. And banks, if you see, even though SLR is just around 18% or so, banks generally have more than 18% SLR. So immediate thing that comes to my mind is financials. But I think all sectors will benefit, because this will impact cost of capital on the whole. Now, one criticism to this entire bond index is because I think 1819 China came in. You didn't see too much of a drop in yields in China in 1819 despite bond inclusion. One reason was the bond market in China was really huge, was very, very large. So it was not a very significant thing. India market is, the bond index, the bond market is not very deep. So this will not be a drop in the ocean. This will actually have some sort of an impact. The only thing that we should pray for is, this is something that we keep writing in our dailies about again and again, is 4 factors that really matter for bond yields in order of importance for India: crude, rupee, domestic liquidity, and inflation. Domestic liquidity and inflation, we don't really see any concerns. Currency, we don't really see concerns at this point in time. Food is the most important. So when this inclusion happens, if we don't have good luck and crude continues to keep moving up, you won't really see any translation from a yield point of view, because your yields will keep moving higher. So if you look at the longer term relationship between yields and crude, they've been almost exactly in line. And our India, so I think for nearly 2 years, we've been talking about how duration probably is the way to be. When India bond yields were actually at 745, 740 thereabouts, we were actually screaming, saying it's a no-brainer that you have to actually go in for a duration, because it's a no-brainer that the markets sort of price in rate cuts nearly 1.5 to 2 years in advance. So that sort of played in that 740 came down to a 7, and then 7 started inching closer to a 710, because there were some concerns early this year of borrowing program, but that came off. It started going back to a 705. But then after that, you had liquidity issues that took it back again to 710, 715. And then after that, crude. Now, even though liquidity is not as much of an issue, crude is a larger problem. So in nearly the last 2 months or so, I think crude has gone up by more than 25-30%. So that, I think, is the most important variable from a yield point of view. If we have good luck, and for whatever reason, around the time of bond inclusion, in and around the time flows start coming in, if crude behaves, crude normalizes, then I think that yield transmission, that positive drop in yields, I think is inevitable. But the only thing that can really spoil this entire party is crude. That's the only thing I can think.
Great. So Arjun, you may take away your screen. You can switch off your screen.
Sure. Just one second.
Yeah. Okay. Finally, so good. Thank you so much, Arjun, for spending sharing such an insightful session with all of us. Okay. Really like your talk, and I'm sure all our participants have enjoyed our discussion and talk from you. Okay. Once again, on behalf of Pentagraph family, I would like to thank you everyone for joining this session. Thank you so much, and see you next month.
Yeah. Thanks a lot, Yogesh. Thanks a lot, everyone. Thank you.